Are you looking for clarity on what a bear market is or even a bull market? Well, stay tuned because in today's episode, we're covering exactly that along with the bid-ask spread and the market limit order. Let's get right to it. Hey, welcome back, investors. This is the New to Investing show. Jason here. In today's episode, we're going over part 2 of the most basic investing terms that you need to know. Here are the topics we have to discuss today. Our first one's going to be bid-ask spread, bull market, bear market, and our last one that we're going to be talking about is the limit order. Let's kick things off. All right, our first term of the episode is going to be bid-ask spread. As you can see on the screen here, the bid-ask spread is the difference between what people have to spend and what people want to get it. The spread must be resolved before the transaction can take place. Now, this can be a little confusing to new investors, so I've gone ahead and broke it down to 3 bullet points. Let's take a look. The first bullet point states, the amount the ask price exceeds the bid price. The ask price is the price sellers are looking to sell their shares of stock at. The bid price is the price buyers are looking to buy that stock at. So in short, the bid price that you see is the highest price that a buyer is willing to buy a stock at. Now, on the opposite side of that, the ask price is the lowest price a seller is willing to sell those shares at. Let's continue to bullet point number 2. There are going to be multiple bids and asking prices, but this spread captures the difference between the highest price that a buyer is willing to pay and the lowest price a seller is willing to sell at. So in the real world, and even on the stock market, if I'm trying to sell specific shares, let's just say it's AMD or Google, if I want to sell it at a certain price, I'm just one seller. There's multiple sellers in the market that could offer a sale price or a selling price that's a lot lower than mine or a lot higher than mine. So when you're looking at the bid-ask spread, those that bid and that ask are always going to take the highest and the lowest. What's the highest price a buyer is willing to pay for a certain stock? And then for the asking price is what's the lowest dollar value a seller is asking for their stock. So there's going to be multiple different prices out there, but it's always taking, again, the highest price a buyer is willing to pay for the stock and the lowest price a seller is looking to sell the stock. To help kind of better explain this, let's go to the third bullet point. Hopefully this will explain it more. If I'm looking at shares of AMD, it currently has a bid price of $50.25. But then as you can see on the screen here, it has an asking price of $50.27. So majority of buyers, the highest buyer out there, wants to buy 900 shares of AMD at $50.25. Now, the lowest price a seller is willing to sell it at is at $50.27 for 1,400 shares, which gives you a spread of 2 cents. And so what our first definition says is that 2 cents, that difference, that spread right there, has to be resolved before any transaction can take place because there's no overlap. There's buyers that want to buy it for $5.25, but there's no sellers in that range. There's only sellers at $5.27. So that spread's going to fluctuate, and until those prices overlap, then that sale of that stock will execute. And then one quick thing to note, I mentioned a second ago, but when you see that bid-ask spread, you're going to see that times symbol and then a number to the right of it. That's always going to symbolize the amount of shares that person is willing to buy or sell. So in this example, we had $50.25 with that, that X, that multiply of 900. That just means at 900 shares, they're willing to buy those 900 shares at $50.25. You then have a seller for the ask price, again, at $50.27. They're willing to sell 1,400 shares. So hopefully that made more sense. If it doesn't, we'll touch on it more in a little bit, but that's the bid-ask spread. Let's get to the next one. All right, for our second term of the episode, it's going to be bull market. As you can see on the screen, a bull market is a market condition that means stock prices are expected to rise. Now let's go ahead and break it down into 3 different bullet points to help you build a better understanding of it. Our first bullet point says, a bull market is often used to describe the stock market that can be applied to anything that's being traded, whether that's bonds, real estate, currencies, and commodities. So although you normally hear the term bull market applied to the stock market, it can be applied to multiple different things, including the ones I just mentioned. Now, the second bullet point states, the term is typically reserved for extended periods in which a large portion of share prices are rising. It's not really used to describe daily trading where prices fluctuate, meaning the term bull market is just meant for long-term periods, not day-to-day or hour-to-hour growth and decline. It's usually, if it's a long period of time, multiple days or even months, I think it's about 2 months, if the market is trending upward or in positive growth, most analysts and most investors consider that a bull market. So it's not just hour to hour or day to day. You have to see this long, extended period of time that's consistently growing or consistently in an upward trend. That's what a bull market is. And then really to drive home the point, the last bullet point says, bull markets symbolize investor optimism, confidence, and expectations that strong results should continue for the future. Meaning, in a bull market, most investors believe that that growth, that upward trend is going to continue. Therefore, you're in a bull market. Everyone is kind of optimistic and confident that prices are going to continue to rise, things that are going to continue to perform well. So that's what a bull market is. Let's go to the next term. All right, our third term for the episode is going to be bear market. As you can see on your screen here, a bear market is one in which investors expect stock prices to fall. There is where short sellers shine. Now, we're not going to discuss short selling in this episode. We will in a future episode. But for the time being, just know that investors are expecting stock prices to fall. That's the most important thing of a bear market. To really drive home this term, I got 3 bullet points to help go into more detail about a bear market. Let's go over the first one. Our first bullet point states, bear market is often used to describe the stock market, but can be applied to anything that is being traded, such as bonds, real estate, currencies, and commodities. Again, this is identical to a bull market. Bear or bull market, it's usually done for the stock market or used to describe the stock market, but it can be used in other markets as well. The second bullet point we have here says, the term is typically reserved for when the market prices fall 20% or more from recent highs for a sustained period of time, typically 2 months. And just like what we were saying for the bull market, a bear market is when the market usually hits highs for that time period. If it falls 20% and it maintains that downward trend or that loss for typically about 2 months, most investors and most experts and analysts consider that to be a bear market. Again, it's just a huge decline in overall prices throughout the market, like the second bullet point says, about 20%, but it has to sustain that for at least 2 months. There's not an exact time frame, but for about 2 months, you're usually in that bear market. Again, this isn't going to be a day-to-day or an hour-to-hour thing. Prices are going to fluctuate. Sometimes it's going to be more volatile than others. Prices could be going up and down in large, discrepancies from highs and lows. But as long as you're trending downward and it's consistent for about 2 months, majority of people are going to say you have entered a bear market. And to drive that point home and kind of symbolize what a bear market is, that third bullet point says, bear markets symbolize investor pessimism, lack of confidence, and poor expectations for market results. Investors are just not super confident in stocks in general. If it's a bear market, maybe quarterly results, they're not expecting things to be going too well, whether that's, the world politics or any sort of major world event is driving investors to stop, buying as much. People aren't investing as much. Stock prices are going to be coming down. As long as it maintains that downward trend for about 2 months, that symbolizes a bear market. So hopefully that makes sense. Again, bull market, when things are moving upward when things are moving upward and have consistent growth, and a bear market is when things are moving downward for a consistent period of time. So hopefully that helps. Let's go to the next term. All right, and for our fourth term of the episode, it's going to be limit order. As you can see on the screen here, a limit order provides instructions to only execute at or under a purchase price or at or above a sale price. Always use limit orders, not market orders. What does that exactly mean? We have 3 bullet points to give you a little bit more detail and to help you kind of understand what a limit order is. The first bullet point says, a limit order guarantees that an order is filled at or better than a specific price level. It can be used for both buying and selling stock. So if I had a stock that I was interested in buying and it was at $40, but I thought that price was a little too high, I could place a limit order for $39. And so as that trading throughout the day occurs for that stock, as it goes up or down, if it does go down $1 and hits that 39 price a share, my limit order is going to execute and I will buy my shares at that $39 price. That's sort of an automated thing. Like you can place in limit orders and your brokerage will save that order and will only execute if that stock price hits your level. So you could go about your day, you could go throughout the day or even the week. You could have, you could set it for just the day or just the week or just for, until further notice, until for the full future, you could have that limit order. So that's some automation. You don't have to always be looking at the stock market and at the stock price. If it hits the value that you want to purchase it at, then it will execute. And same thing goes for selling. If you want to hold on to a stock and it's at $40, maybe it's at an all-time high, and you're looking to get out soon, but your sell price is about $42, you could put a limit order to sell at $42. And so as that stock increases and decreases throughout the day or the week or the month or even the year, as soon as it hits that $42, your brokerage will then automatically sell your shares at $42 depending on how many shares you've listed to sell. It's as simple as that. Let's go to the second bullet point. A limit order is not guaranteed to be filled if the share price never reaches your limit order price. This can result in missed opportunities and fast-moving market conditions. So just like the last example, if you're willing or if you want to sell that stock at $42 and it's at that $40 price at all-time highs and you want to go up $2 more a share, what if it never hits that $42? If you have a limit order, again, it's sort of that automation's in place. If that stock hits 41 and majority of investors are selling at that price instead of 42, that stock price could fall. That stock could tank. It could go drop down to 35, 32. If it never hit that $42 per share, you're going to lose out on selling those shares. If it never hits, it will never sell. And the same thing with buying. If you're looking at a stock that's trading at $32 right now and you want to buy it at 30 because you think it's going to take off soon and you just want to get in at a lower price, if you have a limit order for $30 and it goes down to 31 and then a lot of investors start purchasing it and it shoots all the way up to $40, $45, if it never hit that $30 price, your limit order will have never executed. That automation never kicks in. So there are some downfalls of it. Majority of the times it's a good thing if it teaches you to have some sort of confidence in your strategy of when to get in and get out. It's really useful for when you really like a stock, after doing your research and your homework it's going to hit a certain price, place in that limit order and then forget about it. Let that automation take place, let your brokerage take over, and then as soon as that is executed, you'll be notified. And then if it's a long-term stock you can hold, but if it's a stock you just want to hold for a short period of time, you then could just place in another limit order for your sell price. It's as easy as that. And again, we've gone over a few examples here, but I have an example on the screen here in the third bullet point. If Costco is currently trading at $310.51, I could put it, and I want to purchase it, I personally could put it in a limit order purchase for $300. So if Costco opens up on Monday and it drops $10.51 per share, it'll be right at $300, and then my automated purchase that I have in place through my limit order will kick off, and I will then purchase that amount of shares, however much I determine or put into my brokerage. I will purchase that amount of shares for $300. I can do the exact same thing for selling. If I want to buy Costco or if I want to sell Costco at $320, I put in that limit order for $320. And if Costco opens up Monday and goes up almost $10 a share to $320, then my sale will kick off. I will sell my shares at $320 per share, and then I will get that money back, obviously. So limit order, very useful, very important to know. And for all new investors, all newcomers to investing, that this is something to definitely play with. Try out once or twice for your first or second stock purchase. It's extremely helpful, and it kind of takes away that anxiousness to buy a stock. You can put a price and then kind of walk away and forget about it and relax, knowing that you have a game plan, you have a price to get in or to get out of a stock. So super important to know and to utilize. All right, let's go to the next slide. All right, investors, that's going to be our 4 terms for the episodes. Let's quickly go through our takeaways and wrap things up. Our first takeaway: bid and ask price has a quantity attached to it. So when you're doing your research on a stock, you'll always see that kind of multiplier, that times, and the number to the right of the bid or ask price. That's just going to symbolize the amount of shares that a buyer or seller is willing to purchase or sell that stock at. So if it has, let's just say it's AMD, $35.10, and you have that multiplier of 900, that just means that a buyer is willing to place a bid in for that price and buy 900 shares. Same thing with selling. Super important to know. Our second takeaway is going to be about the bear and bull markets. They usually show trends of confidence in the overall market for an extended period of time, usually about a 2-month period. If it's in a bull market, kind of think of a bull swiping up with its horns. That means the market is in an uptrend. Investors feel confident about the market. They're purchasing more stocks. Stock prices in general are increasing. And then again, the opposite of that, a bear market, kind of clawing downward. Investors don't feel too confident. There may be some outside activity in the world that's driving prices down or lowering investors' confidence. You usually, if it's happening for 2 months, you have entered a bear market. Prices are downward trending. Super important to know. And our last takeaway is going to be limit orders can be used to automatically buy and sell at specific prices. This is a topic and a term that I touched on in great detail just a second ago. But again, limit orders can be used to set your absolute lowest price that you're willing to buy a stock, and then you can set a price that you're willing to sell your shares at. So you can set your limit order, walk away, and that automation through your brokerage will kick in, and then it will either buy or sell your shares depending on if you're looking to purchase or sell a stock, and if you do it through a limit order. So again, all super important terms for new investors. Hopefully all of that made sense to you. If not, leave a question in the comments and I'll try to explain in further detail of each term. All right, thanks. All right, investors, time for my favorite part of the episode. For today's fact of the episode, we have the following. There are 60 different major stock exchanges throughout the world. The $1 trillion club of exchanges only consists of 16. These 16, which include the NASDAQ and the New York Stock Exchange, have 87% of global market capitalization as of 2015. That is pretty darn incredible. Just those core 16, or just those top 16 stock exchanges in the entire world out of 60, they have 87% of all market capitalization. That is pretty incredible, and we know that 2 of those are from the United States, the NASDAQ and the New York Stock Exchange. Pretty incredible. Before we end the episode, I want to go over a quick disclaimer. The New to Investing show is for informational purposes only and is not intended to serve as a recommendation to buy or sell any security and is not an offer or sale of a security. The New to Investing show is also not a research report and is not intended to serve as the basis of any investment decision. If the New to Investing show covers a service or security that one of the hosts uses or owns, we'll make sure to let you know. Hey investors, I hope you enjoyed today's episode. If you learned something new or found the episode entertaining, please feel free to leave a like and subscribe to the channel. It really helps grow the show and I'd greatly appreciate it. If you're interested in learning even more about investing and money management, then you can head on over to YouTube, Twitter, Instagram, and or Facebook and just search for New to Investing Show. I've also provided the links in the description below. Thanks for watching.